Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The unemployment rate for February came in yesterday at 4%. It was a very, very strong set of numbers for the labour force, with employment rising by 77,000 and a record participation rate. Unemployment is now at its lowest rate since August 2008, and back then the cash rate was 7.25%. Today, it's at 0.1%. To help make sense of it all, I welcome back Carlos Cacho, the Chief Economist at Jarden Australia. Carlos, welcome back to Fear and Greed.
Thanks for having me, Sean.
What do you make of the labour force numbers yesterday?
Any way you cut it, this report is a very, very strong signal of just how much of a good place the labour market is in at the moment. If you look at jobs growth, that was strong, as you mentioned, 77,000, all of that full-time. Participation is at a record level, so the supply of labour, more supply of labour is getting pulled in by the strong labour market. Unemployment and underutilisation, both at the lowest level since 2008. Unemployment, in fact, the equal lowest in over 40 years. You have to go back to the quarterly data in the 70s to find an unemployment print below 4%, and we're probably going to see that in the next month or two. And hours worked up almost 9%, so largely retracing the fall we saw in January driven by Omicron. There is still a bit of weakness there because of Omicron. You're still seeing more than usual people not able to work or working fewer hours than normal because of illness. But we've seen a lot of the drag we saw in January has really bounced back strongly.
So it's a simple question, but I actually think it's a really difficult one to answer. Why? Why is the labour market so strong?
Well, I think you need to really think back to the level of stimulus that's gone into the economy over the last 2 years, whether it's the RBA cutting rates to 0.1%, the various other stimulatory measures they engaged in, the quantitative easing program, the term funding facility, the huge amount of government stimulus we saw, JobKeeper, the support for businesses, that's all come bubbling through now. And we're seeing just a very, very strong macro backdrop. We've seen business investment intentions the best since really the GFC. We're seeing consumption growth very strong at the moment. We're seeing consumer confidence and business confidence, though they've dipped a little bit recently given the global issues, still remain very solid. And you're seeing a very high level of investment, in areas like housing as well as mining. So many parts of the economy are doing well. There's a lot of money going around. And at the same time, we've had closed borders. So the supply of labour has been a bit more constrained than it might normally be, which is seeing unemployment fall a bit faster than it might otherwise normally fall.
The missing piece of the jigsaw puzzle in terms of interest rates still seems to be wages growth. Do you think we'll start seeing growth in wages come through, which will allow the Reserve Bank to stick to its word and start lifting interest rates?
Yeah, I think we're starting to see the early signs of that. Wages growth has picked up a little bit over the last 6 months. It's still only back to where it was in 2019, but we're looking at some other leading indicators. We're definitely seeing signs that it is starting to percolate through the economy. The underutilization rate, which is both people unemployed as well as people who would like to work more hours, is one of the best leading indicators for wages growth, and that's back to 2008 levels and consistent with wages growth above 3%. When we go out and talk to firms and businesses, we're hearing from them that it's very difficult to hire labour. In many cases, they're having to offer wage rises of 10 or 20% in some industries. And so while it's not impacting all workers, we're certainly seeing signs of it and hearing more anecdotes of wages pressure coming through. Our expectation is that by the middle of this year, we should have some pretty firm signs that wages growth is picking up at around 3%, which is what the RBA would like to see. The one thing to bear in mind for Australia is that we do have more than half of the wages are set by enterprise bargaining agreements, which usually last 2 or 3 years. They're not renegotiated every year, and the award wage system, which is the annual minimum wage review. And so that just means that it takes a little bit longer for some of those wage pressures to come through to the broader labour force. But we should start to see those emerge later this year, particularly the award wage review in July. I would expect to see a material rise in minimum wages, given inflation's probably going to be running above 3% and perhaps above 4% by then.
Isn't there the risk then that wages suddenly will grow very, very quickly and we're behind the 8 ball?
Well, look, certainly there is a risk of that. I think, one thing, the RBA has highlighted the fact that wages respond a little bit slower in Australia because of that rigidity in our wage setting mechanism. That also means that higher wages can become more entrenched. If you've got most enterprise bargaining agreements last for 3 years, so if you're putting in place a wage rise of 3 or 4 or 5%, then that's going to stick around for a while. So there is a risk of that. We'll just have to kind of see how it flows through the economy. I think the expectations are generally that we should see this managed well, but I think the risk of in both Australia and the US and indeed most developed nations is that we see wage pressures and inflation pressures run ahead of expectations in the near future.
So what do you think the Reserve Bank will do? When's your forecast for when it will lift interest rates?
At this stage, I've penciled in the first hike for September this year. The risk is probably earlier, particularly given the signs that inflation is going to overshoot there and potentially market expectations. I think they're probably just going to want to see a bit more confirmation that wages growth is actually coming through in the data before they do that. And we'll get another measure of wages in mid-May and then another one in mid-August. So I think they'll probably take two more of those measures before they're comfortable with increasing rates. But if inflation surprises materially to the upside and the May reading for wages proves to be stronger than expected, they could potentially move sooner.
Stay with me, Carlos. We'll be back in a minute. My guest this morning is Chief Economist at Jarden Australia, Carlos Cacho. Now, last week, Philip Lowe, the Governor of the Reserve Bank, said it was plausible to think about an interest rate rise in 2022. That doesn't mean it's his central case scenario, but certainly all the talk now is about a rate rise at some point this year rather than 2024. That's been quite a shift in the last couple of months.
Absolutely. The RBA has been surprised to the upside with the strength of the economic recovery and the strength of inflation. And I think, if we look back to December, before they updated their forecast in February to the November meeting, back then we were just coming out of lockdowns. It was before Omicron hit. It was before the war in Ukraine. And the outlook was still quite uncertain. Fast forward to now, and the economy is clearly very strong. The key real risk in Australia and in most developed economies is inflation running too hot, particularly with commodity prices doing what they're doing. Yeah. And so I think the RBA is rightfully adjusting their view of things. They're likely to pull forward their forecasts. We saw today unemployment is already at 4%. The RBA wasn't expecting we'd get to 4% until June. So we're again running ahead of their expectations. And I suspect in a couple of months' time, over the next couple of months, we will continue to see their rhetoric shift. But it's a good thing. The economy is strong, and the reason the RBA is considering hiking rates is because the economy is so strong. So it's a positive. It should be a positive in that sense.
Okay, the other big news yesterday was the US Federal Reserve raising interest rates for the first time in 3 years. Also, they rose interest rates by 1/4 percentage point. They also outlined basically a timetable to keep lifting rates for the rest of this year. They'll get to at least 1.75% to 2%. It seemed to calm markets generally. What sort of impact does that have on global markets, but then locally?
Look, I think the Fed meeting, it was quite interesting actually to watch. I got up early yesterday morning to listen to Chair Powell's speech. And initially on the announcement, you did see the market sell off. And then as he started speaking, the market rallied again. So I think he managed to calm the market's nerves with the level of hikes that the Fed is expecting, which is, as you said, one at every meeting this year. I think, what it's telling you is that emergency policy is no longer needed. We're going to see higher rates. That probably means that interest rates across the curve need to go up, so bond yields need to rise. In terms of what it means for Australia, it will drag up our bond yields, just given the fact that Australian rates are traded globally, and so given other options that will force that higher. And it makes the RBA's job easier. If they're hiking rates in an environment where the Fed is hiking more aggressively, it's going to mean that there's not the upward pressure on the currency that you might normally expect from central bank tightening. So that just makes it easier for them to tighten as they need to.
I thought the Fed did a really good job yesterday. The Reserve Bank used to call it jawboning, the idea that it actually just looked as if it was in control. And what the chairman was saying, people liked to hear, because everyone, after the commentators were talking about, well, it's not out of control. It's not like we don't know where the end of the rate cycle is, because he's indicated where that will be. It was kind of a good job in controlling markets, or at least soothing markets.
Yeah, I think he did a very good job of kind of balancing the view that, yes, we're increasing rates, we're increasing them a lot, inflation's high, but he was sending a confident signal that they're going to proceed carefully and cautiously, but that they're going to focus on getting inflation back down to their target. I think the important thing was he didn't rule out hiking more aggressively, but he also didn't rule out potentially, going slower if the outlook changes. One interesting thing though was he certainly avoided the questions around what they would do if the unemployment rate were to rise, And the Fed is forecasting that the unemployment rate does remain around 3.5% despite increasing interest rates by more than 2%. So that will be certainly interesting to watch. The story they're telling us is that they think they can hike rates and get inflation down without unemployment lifting. That's really going to be the key test, and to see how do they decide to make that trade-off between unemployment and inflation, because generally speaking, getting inflation down without unemployment rising is not as easily achieved as hoped.
Carlos, do you like days like yesterday where there's just so much going on?
Look, it certainly makes the job interesting and challenging and keeps you on your toes. But it's also nice to have those quiet days as well, where you can think a bit further ahead and not worry about the flurry of the day's activity. So, takes both types of days to do the job well.
Keep you happy. Fair enough. Thank you for talking to Fear and Greed.
Thanks for having me, Sean.
That was Carlos Cacho, Chief Economist at Jarden Australia. This is a Fear and Greed daily interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.